Joining us now for First on CNBC interview is Wells Fargo CFO Mike Santomassimo. Welcome back, Mike. Good to have you.
Thanks, Sarah. Thanks for having me.
It was such a messy quarter because of those penalties. It was almost hard to see what the underlying trend in the business was. How would you characterize it?
Well, I think when you look through to the operating results, it was really good, solid progress again. And I think you look at, whether the benefit we got in net interest income from higher rates continuing to come through in a pretty substantial way. You saw really good, credit performance again, strong capital position remaining. Expenses were well managed, while we continue to invest and roll out new products and add new people to cover clients. And so I think overall good, solid operating performance, even though the quarter did have impacts from, the litigation and regulatory and remediation, costs that we had in the quarter. That stuff helps us really put some of these historical issues behind us.
Well, right, but we've been talking about them for so long. Are we finally getting to a turning point in the regulatory issues or not, Mike?
Well, I think, what happened in December actually is a big step forward. We still have more work to do, so I wouldn't say we're done with all of what we've got to get done. But I think it was a big step forward in terms of really putting some of those, some of those issues behind us.
You mentioned the net interest income. That's what everyone is paying attention to with all the banks. And clearly it was a big jump, 45% from last year. Those Fed rate hikes certainly help. The forecast, though, 10% in 2023. Why was that not higher? Some were disappointed with that.
Well, I think you have to look at the factors that go into it. As you said, it was really good, performance. And as we came into this environment, we were set up pretty well to take advantage of, higher rates, through all the work that we've done over the last couple of years to really optimize the balance sheet. But as you look forward, it's really all the basic drivers that are going to, decide where we end up for 2023. It's what's going to happen with deposit balances as consumers continue to spend and in some cases move to higher yielding alternatives. It's going to be deposit pricing and the competitive environment around that. And then ultimately it's going to be loan growth and what materializes there. And that's all in the backdrop of what happens with rates, which is still a little uncertain in terms of exactly what that path of rates is going to look like for the rest of the year.
So what are you guys expecting? You added to your loan loss reserves again, as others did. What is the signal there as far as your expectations for what's going to happen to the economy?
Well, it's clear that the economy is going to continue to slow, right? And I think that's going to be the result of it ultimately as the impact of higher rates really takes effect. And you're starting to see a little bit of that now, and you're seeing a little bit of stress in some consumer segments. But overall, the increase in our allowance, the majority of it was actually driven by higher loan balances, particularly credit card balances, came through, and a little bit was related to the economic environment. So it's really a sign of continuing to see that growth in the investments we're making in the card business, which we're glad to see come through the numbers. And then the overall economic environment, is a smaller piece of it.
What about the housing market? You guys are really shrinking the mortgage business with that announcement this week, ongoing process. Why are you doing that? And what do you see ahead for pain in this market?
Well, what we're doing is making sure we really focus on, our, primarily on our wealth management and consumer clients. This, mortgage is still going to be a really important business for us and a really important product for those customers, but we're going to focus our energy there, in addition to really making sure we do a good job and even expand the things we do, for minority communities to help support that piece of it. But when you look at the backdrop of what's happened in housing, you're starting to see some price declines in across the country. Nothing super substantial yet in many places, but you're starting to see that. And given where rates are, you're seeing mortgage applications still at a 25, 26-year low based on some of the industry data there. And to state the obvious, refinance volume is very low, just given where rates are and where it just doesn't make sense to refinance, your mortgage in most cases. And so I think you're going to continue to see a pretty challenged, market there, across most of the mortgage players. And then, many of the industry, including us, are continuing to make sure, our business is right-sized for that expected volume over the next year or two.
I was wondering what the outlook is there for that pressure. And finally, big news that you're restarting the buyback in Q1. What gives you the confidence to do that now with so much economic uncertainty ahead?
Well, it starts with our really strong capital, position of where we are. When you look at, our CET1 ratio of 10.6, well above where we need to be from a regulatory minimum and buffers, and so that's where it starts. We feel like we've got plenty of, capacity to continue to support our clients. You see a little less pressure from interest rates on the overall balance sheet. And so we feel really, confident that we will be able to we'll be able to restart that, this quarter and still, continue to be there for clients and still keep a really strong capital position.